So I am absolutely delighted to chair this session of three central bankers. And also, all of them have made very important contribution in academic contribution, but here I think they are as central bankers. So let me start at the edge. Federico was the president of the Central Bank of Argentina. Silvana is with the Bank of England in the Monetary Policy Council, and Jim Bullard is the president of the Federal Reserve Bank of St. Louis. The topic given to this panel is back to 2% inflation ? So I guess the alternative is going to a different rate of inflation. So let me just say something briefly about the topic. So in 1990, New Zealand went for an inflation target of 2. Thereafter, many, many countries also adopted an inflation target of 2. In 1990, as I would argue now, there was not a particularly good reason to pick 2% over 1% or 4%. Maybe the view has slightly changed, but what happened also, what was pretty clear in 1990, that this inflation targeting idea was premised on a regime of non-fiscal dominance, and I think that was very well understood, so there was not a major new insight there. And then what followed were 20 years of unprecedented low inflation and stable inflation. So if we now revisit that question with many years past, I would say that what the inflation target gave us, and that we understood already in 1990 or anticipated, was enormous credibility to the central bank. And as such, the question is, would it make sense to move around the target, maybe endangering credibility? And in particularly, why would we like to move it right now? It's like moving the goal when we are behind in the game. So with that short introduction, our first speaker is James Bullard from the Federal Reserve Bank of St. Louis.
Great. Thanks very much. Thanks for having me at this excellent conference. Zhou Enlai was the premier of China in 1972, and he was famously asked what he thought the impact of the French Revolution would be. And he gave a famous answer, which was, it's too early to tell. But if you've been following this quote, it's recently been come into question because the translator now says that he wasn't really responding to the question of what he thought about the French Revolution. It was about events in France today. But the translator said it was too delicious to correct the quote. So I view myself as a bit of a translator of earlier work done by Guillermo Calvo, and you can tell me whether I've got it right or whether it's just too delicious to pass up. So this is about credible and incredible disinflations. And obviously the US inflation rate has been running above 2% and has actually been running at 1970s levels. And the key question for current monetary policy is whether we'll be able to disinflate in the US relatively painlessly, relatively easily and quickly, or whether we have to go through a searing event like the big 1980-82 recession associated with Paul Volcker's leadership at the Fed. And a lot of financial market participants, some might be in this room, and others are saying the only way to do it is to have a huge recession, and they're basically reading that off the Volcker era. But the story in this talk will be different. I'm going to tell a story that relies a lot more on credibility issues and a lot more on fiscal monetary interaction, which are key themes in the work of Guillermo Calvo. So here's a picture of the inflation rate in the US. This is headline PCE inflation. This is what our inflation target is stated in terms of. The target is there, the horizontal dotted line. You can see the 1970s there, very high, And then over on the right-hand side, you can see the current numbers, and it did peak very much at similar levels that you might have seen in 1975 or 1976. I would also point out here that the inflation targeting era, implicit inflation targeting era in the US, I think began in about 1995. That's when we implicitly, Greenspan Fed implicitly adopted a 2% inflation target, and we ratified that in 2012. Whoops. The Volcker disinflation was costly, but not credible. So initially, very few people believed that Volcker was going to go through with the disinflation, and so you had to convince markets that we were going to actually do it. And here's some literature on that, all of which I recommend. You might look at it more carefully. But part of the post-Volcker literature turned to something else to analyze how could you do a disinflation credibly and possibly costlessly. And most famously, Sargent had the paper, The Ends of Four Big Inflations, and you would not have to have a large output cost. So what we're talking about, you know, the Volcker disinflation, just to remind you, unemployment in the US hit 10.8%. That's the highest of the post-war era. So the idea would be that the reason the Volcker disinflation was costly was because Volcker had to earn credibility, and if you didn't have to earn the credibility, then it might go a lot faster and a lot better. So the idea for today is that what we've got is more like the credible disinflation scenario than the incredible disinflation scenario that Volcker had, because modern central banks have a lot more credibility than their counterparts in the early 1970s or the 1970s. So we may be able to disinflate more easily. Now, this is going to, as you know from the Sargent literature, would require a credible switch from the wartime pandemic policy, which had lots of fiscal spending and lots of easy monetary policy, to a post-pandemic less fiscal spending and less accommodative monetary policy. So you'd have to make that regime switch in order to get this disinflation to occur. So I'm going to argue that we can do that. There's a little delay, so you never know what's happening here.
Monetary policy lags.
Okay. Let's look at some Phillips curve numbers here if we can. Hello. There we go. All right, so on the Phillips curve, I think a lot of people that are thinking that the disinflation will be costly are just going straight off Phillips curve estimates. Here are some of them. Stock and Watson, practically zero slope in the Phillips curve. Amy Nakamura, slope of minus 1/3. But if you're just going to use this mechanism, you're going to have a ton of unemployment in order to get inflation down. So if that's what you're thinking about, it would be very hard to get back to 2% inflation. But that calculation doesn't say anything about the role of expectations. The new Keynesian Phillips curve has two arguments. One is an output gap term and one is an inflation term, gap term. And that would suggest, this is the anti-warning slide. That would suggest a very close relationship between expected inflation and actual inflation outcomes, and it seems like you could exploit that to get the big disinflation that you need in this environment. I'm going to argue, contrary to Ivan yesterday, I'm going to argue that this actually seems to hold in broad terms, and so that we can do this. So this is my killer chart for Ivan. I've already sent it to him. I like this chart, and I'd like to hear what your reaction is to it. And it seems like it's just two lines on a graph to you, but to me it has deep meaning. The one line is core PC inflation, which is what the Fed likes to look at. When you're looking at real data, you have to filter out a little bit. It's measured from 1 year ago, so it's a little bit smoothed. And then the blue line is the 5-year break-even inflation rate that you'd calculate off the TIPS market. So I like break-evens because they react to data immediately, and they're good from my point of view in interpreting events in financial markets. And the correlation there from 2002 to 2019 is super high, and these things wouldn't have to be so closely related. But if you bought into the new Keynesian model and all the assumptions that are behind it or related models, they're going to tell you that these two things should be highly correlated as part of the general equilibrium with a credible monetary authority. So that seems to be occurring here. And then you get over on the right-hand side and you get something happens and core inflation goes way up and inflation expectations don't go up nearly as quickly. So to me, this is a vindication of the idea that actual inflation should be related to an expectation out there in the future. And I like to use 5 years because the 5-year is some notion of how far, when can the policymaker have actual impact. You probably can't do anything over the next year, but you probably can do something over the next 5 years. So this is something about the credibility of the policy authority. Fernando?
Clarifying, this is 5 years?
From now.
From now?
Yes.
The one expected contemporaneous to the 5
Right.
years, and the other one?
Other ones, so the left-hand side of the Phillips curve is backward looking. The right-hand side is the expectation. So there was this literature from Sargent that said it was the credibility of future monetary fiscal policy that would cause the substantial adjustment in inflation expectations today, and hence in actual inflation today. And in particular, in the ends of 4 big inflations, he said, well, there were these hyperinflations in the defeated countries in Europe after World War I. They basically ended on a day when a credible regime change was made that promised less fiscal excess and orthodox monetary policy, and the inflation ended immediately without any output cost. So this was his evidence. But these historical episodes are not just about what does the central bank do. These are monetary fiscal adjustment schemes and their regime changes. So Goodfriend and King stressed the idea that Volcker had to take actions to earn credibility. And Sargent has talked about this just a few months ago, or last year, I guess, saying that there could be, if you have rational expectations, you can't really talk about earning credibility. So you have to back off rational expectations a little bit and talk about how the policymaker could be earning credibility. There are some papers that do that, and those papers would associate the costliness of the disinflation with how much credibility does the central bank have to earn. So where are we today? We have considerable credibility today compared to where we were in the 1970s. And by this, I mean not just personalities involved and stuff. I would say institutionally. You have more political support for, let's say, the ECB or the Fed. You have more, you have an inflation targeting regime that has more credibility. You have a track record of achieving 2% for quite a while. So you have a lot more credibility in those senses. But it's not just the monetary guys. It's not just the credibility of the central bank. It's the monetary fiscal adjustment that has to occur. So let's think of COVID-19 as a global war, a social upheaval. And what happens in a social upheaval is that the government starts spending a lot of money without asking too many questions about future taxes, and they lean on the monetary authority to support the war effort. So Now, Giancarlo talked yesterday about, well, you're taking risk, you're gambling. So there was a sense of we want to do more than it may be necessary to contain what might happen from the pandemic. And you're kind of risking a high inflation regime. We actually got that high inflation starting in 2021. So what do you do now? Now you took some risk because of the social upheaval. Now you got some inflation. How do you get back? You have to have a regime shift back to the pre-pandemic policy. So is that happening? I think on fiscal policy it is happening. We have a divided Congress now. It's unlikely to spend at the same level that it spent during the pandemic. And you have a Fed that's getting very serious about fighting inflation, raised policy rates substantially, back off on the balance sheet expansion. So you could interpret that as a regime switch back to the pre-pandemic monetary fiscal mix. Do financial markets believe it? I have another killer chart for you. 2 killer charts in one presentation. Can you believe it? So they do, and here's the killer chart. So this is swaps-based inflation expectations at 2-year, 5-year, and 5-year forward. In the first quarter of 2021, if we were sitting here then, there wouldn't have been any inflation in the U.S., and no one was talking really very much about inflation in the U.S. So markets had low expectations for inflation. Something a little above 2 is considered consistent with the 2% inflation target because these are CPI-based as opposed to PCE-based, and also because of inflation risk premium and other factors. So that part, the circle part on the left is actually very consistent with continued 2% inflation. Then in the middle, credibility started to erode. That's how I read these things. Credibility started to erode. It wasn't at all clear that the Fed was going to act enough, especially in 2022. We hadn't, 1 year ago, we hadn't actually done anything, and inflation was continuing to go up. But now we're, after all these 75 basis point increases and everything, market expectations are back down. So I think it's working so far, but we're not back to 2% yet. So that's my story. We have high inflation today. The Volcker disinflation was costly, but not credible, so that's not really the one to look at. That disinflation story is not the one to look at to try to assess what's going to happen today. There was a separate literature on costless disinflation or soft landings. You could tell a story around this as long as you think of the pandemic as some kind of global war or social upheaval. And it looks like we're switching back to the pre-pandemic policy. So I'll stop there. Thanks very much. Thanks for having me.
Thank you very much, Martin and Andy, for inviting me. It's a great pleasure to be here celebrating Guillermo's incredible contribution to economics. I met Guillermo in Tucumán right after the tequila crisis, and when he came to teach for the international master's program in Tucumán. I was an undergraduate student, and Guillermo kindly let me take his course or sit through his lectures, and which was a huge privilege and an enormous inspiration. Since then, I always looked up to Guillermo, and I've been silently grateful. So I'm glad to be here to say finally thank you, Guillermo, for all you've given me and all of us and economics as a whole. So on the topic of coming back to 2%, I'll make 3 points. First, there are many striking similarities in the inflation picture across many countries and jurisdictions, but there are also important differences that matter for the appropriate policy response. Second, with elevated inflationary pressures last year, many central banks have tightened policy very sharply. This has been a massive global tightening. But third, at least for the UK, the shape of the inflationary shock, stemming largely from an increase in energy prices, along with the lags with which monetary policy transmits to the economy, this means that the most likely scenario now for the UK is actually undershooting the target in the medium term. While the US, the UK, and the euro area have all seen inflation well above their targets last year, the underlying drivers of that inflation differ. In the UK and the euro area, the main driver of above target inflation has been the extraordinary increase in energy prices. In the UK instead, stronger domestic demand has played a bigger role in driving inflationary pressures. And one way to see this is to look at the evolution of the terms of trade, which measures the prices of goods and services that the country exports relative to those it imports. And as you can see in the chart, in over 2021 and 2022, the terms of trade in the US improved dramatically relative to the euro area and the UK. And this has been caused mainly by energy prices and the fact that the US didn't see a large increase or as large an increase in energy costs compared to the euro area and the UK. And also, of course, because the US is a net exporter of energy and other commodities, unlike the UK or the euro area. Another way to see this is to look at the evolution of real household consumption. In the US, consumption recovered very quickly after the pandemic and reached its its pre-COVID level early in 2021 and overtook the pre-COVID trend later that year. Meanwhile, in the euro area, consumption has remained well below the trend, and it's only just reached its 2019 level in the latest data. And then in the last chart, you can see the consumption in the UK. It's not even back to its 2019 level, and it's well below its pre-COVID trend, more than 10%. So this is not a story of strong demand, really, in Europe or the UK. Focusing on the UK situation in particular, the appropriate monetary policy response to a large negative terms of trade shock is not automatic. And this is because higher energy prices can move inflation in different directions at different horizons, as illustrated in this stylized chart. We have direct effects from energy entering directly in the CPI basket, and also indirect effects through firms' costs, given that energy is an important input in the production of goods, and also some services like accommodation, transport, and so on. Through these two channels, the energy shock has driven UK inflation well above target very quickly. But as we know, monetary policy transmits to the economy with a lag. So responding to this one-off price level shocks could be counterproductive and indeed increase inflation volatility rather than reduce it. And this is why UK monetary policy has always focused on returning inflation to target in the medium term, and has focused on those medium term effects, namely inertia and lower real incomes. So inertia, everyone here is familiar, rises because many contracts are implicitly or explicitly indexed to CPI inflation, or because CPI inflation is just a reference point for any contract renegotiation. Obviously, this slows the speed with which inflation returns back to target, especially in the context of a relatively tight labor market. Now, this effect on inertia obviously calls for tightening, and that's what we've been doing, but has to be balanced against the other effect, lower real incomes that come from the negative terms of trade shock, lower real incomes and lower real wealth. And even though energy prices have now fallen down quite a bit, as a consequence of the shock, the UK is poorer than it was before COVID. And this lower real incomes, lower real wealth has already weighed heavily on demand in the past year. It will continue to do so, and eventually loosen the labor market and push inflationary pressures to the downside in the medium term. So the response of in response to this, UK monetary policy has put more weight on these inertial effects and has tightened rapidly and materially, as in many other countries. This has been the fastest increase in rates and overall tightening in the Monetary Policy Committee's history. And this plot here gives a sense of the speed of that tightening and its influence in financial conditions. And as you can see here, while the paths of interest rates differ across jurisdictions, all three show a very sharp tightening over the year, with more than 300 basis point increase for all of them. Now, so far, this has had a very small dampening on inflation, which might lead one to ask whether more is needed and how much more. And of course, monetary policy would always stand ready to do more if inflationary pressures were to persist. But given the monetary policy lags, policy needs to be set based on forward-looking forecasts. And those forecasts right now suggest that the main risk for the UK, sorry, is that we have over-tightened. And this, you can see the mountain here to illustrate this. So this chart here shows the overall shape of UK annual CPI inflation. This is coming from our latest forecast in February. Unsurprisingly, given the fast run up in energy prices, we see a very steep profile on both sides going up and down, with inflation going from 2% in the middle of 2021 to a quarterly peak of 10.7% 6 quarters later, and falling to 1% 6 quarters after that. Now, these forecasts are largely just a consequence of a price level increase in energy and other imported goods, dropping out of that inflation calculation. So if you do the arithmetic, it comes up immediately from that annual calculation of inflation. Now, obviously, we couldn't have known about the war in Ukraine and these huge increases in energy prices in the middle of 2021. But even if somehow we did, let me show you now what would have happened and why it would have been difficult to tighten much more than we have done. So here I layered on the shape of a typical response of monetary policy and its effects on inflation coming from our forecast. I have scaled the effects here to show what would have happened if the committee had tightened rates by 5 percentage points starting in the middle of 2021. This also happens to be the same amount of cumulative tightening that you would get from a Taylor rule that just weights current inflation deviations from target. Now, you can see that despite raising rates substantially, I mean, we're going here more than 8%, the benefits are really small. Inflation peaks slightly lower, but we're still well above target. And there are costs. Unemployment here would be 3 percentage points higher, but more critically for us, and given our remit, which is about returning inflation to target in the medium term, you see that this policy brings inflation to negative territory. So with the policies in place right now, we are undershooting our targets. We are going below 2%. Doing the tailored recommendation would have meant a big undershoot down the line. Now, what if we had known about all of this and were set on hitting the target, the 2% target in 2022? Well, then scaling up would look like something like that. Clearly, the real economy shocks of hitting the 2% target in 2022 would have been huge. I mean, we are hiking rates here by 30% to 30%. But even putting those on the side, those economic costs, the medium-term inflation that we will reach would be horrific and completely clashing with our remit. So this is underscoring the mismatch between the shape of the shock and what monetary policy can achieve given the lags. So to conclude, as many other countries, but not the UK, not the US, sorry, the UK has faced an enormous negative terms of trade shock. Now, the appropriate response to inflation can differ across countries and across time, depending on the dynamics of the shock, the shape of the shock, with obviously a much larger negative demand impact in the case of the UK than the US, for example, and other energy or commodity exporters. And now this assessment of the shape of the shock and the monetary policy lags matters critically now because we need to ask, again, forward-lookingly, at what stage monetary policy may have over-tightened. And anytime consistent monetary policy strategy needs to take into account these considerations, the shape of the shock and what the monetary policy tool can do at what time. I will pause here.
Okay, so good morning. I don't need to say how honored I am, as everybody else, to be here. I want to thank Andy and Martin for the invitation. I actually can't tell you when I met Guillermo because honestly, I don't remember. Maybe he made it so natural that I don't remember, but I can tell you one story, which is that in the mid-1990s, I went back to Argentina and I was contesting for a position as professor in a public university. And the system is that they have a urn with topics, and they pick up a topic, they give you the topic, and then they give you 2 hours to prepare a lecture on the topic. Right? So I go there, it's international finance at the Universidad Nacional de La Plata, go to the urn, a clerk takes out something from the urn, says, well, your topic is devaluations, levels versus rates, okay? This is a clerk telling me this, okay? And I'm sure you all remember there's a very beautiful paper by Guillermo, which is called Devaluation Levels versus Rates. I used to teach that paper in my courses, so it was a pretty easy thing to do. But I think basically the punchline of this is if you don't know Guillermo's work, you can't be a professor at the university in Argentina, okay? So I think that kind of talks a little bit about his influence. Eh? You got the job. I got the job. So anyway, you know, the panel here is inflation back to 2%. So calling an Argentinian to talk about this is a little bit like an oxymoron. So I said there has to be a mistake here. So maybe it's not going back to no. But then I read no, it says back to 2%, not back to 2%. So then I think I got it, and I said this is like when you go to Alcoholics Anonymous. Okay, so you want to talk to the other guy, not because he or she has the solution, but you know he or she shares your problems. Okay, so again, that's the spirit with which I'm making this comment. Okay, so again, when you go to Alcoholic Anonymous, you say, well, you know, you're going to go through a cycle, and the cycle goes through starts with denial, then blame, then acceptance, and then finally resolution. Okay. So, for example, if you say denial, the government in Argentina between 2011 and 2015 said, we have inflation. Let's say there's no inflation. So they intervene the Statistical Institute, and they say, you just say that every month there's 1% inflation, okay? And by the way, this is not a joke, okay? And so they prosecuted every economist who said that there was inflation. I think Miguel Kegel maybe is here, and he was one of those people prosecuted. At the time, I was member of parliament, and they can't take us to jail. So at the end, we were the ones who were informing what the inflation rate was in the name of the consultants and the people who were looking at inflation, because they couldn't take us to jail, okay? So this is when you go to Alcoholics Anonymous and you think your life is shit, and then you listen to the other guy and says it can be much worse, okay? Anyway, but this is the denial, which is a little bit crazy, but the blame is much more common. The idea is, oh, I'm going to say, I'm not responsible for this, okay? So you have to go through the process of blame first. And there you have to be aware of something, which is a theorem that I have, which has no empirical evidence, by the way, none whatsoever. But my theorem says that, I call it the Argentine theorem of inflation, which is that the number of stories for inflation is proportional to the inflation rate, okay? So that means you have more inflation and people start saying all kinds of crazy things about inflation. For example, a classic, distributive conflicts, okay? So for example, Argentina had an independent central bank. For 10 years, we had no inflation. And then we repealed the independence of the central bank, we had inflation. And then suddenly we had distributive conflict, okay? We had not had distributive conflict for 10 years, now we have distributive conflict, the same guys, the same supermarket, the same union leaders. Anyway, so you have to get away of those kind of stories quickly. Of course, supply shocks, energy prices, tariffs, the exchange rate. I have more to say about that in a second, so let me postpone it. But then another classic is that, you know, relative prices change all the time. So whenever the CPI number comes, you're going to see something that increases more than the rest. And there's a temptation to say, oh, this is the reason why there's inflation, okay? So for example, in the US, I remember, I've read this. First it was used cars, okay? And then it was timber prices, and then it was lumber prices, and then it was petrol prices, and then it was shelter. I think now today is shelter. Shelter is the explanation, okay? But that's a relative price. That doesn't mean that the relative price changes. It doesn't mean that the average price has to change, which is a totally different thing, okay? And I have to tell you, as the Alcoholics Anonymous participant, that the CPI will always give you someone to blame forever. So if you want to stay in that loop, you can stay forever, okay? So you have to try to get out of that loop. And but my preferred story about blame is, again, in the 2011-2015 period, well, inflation went up to 40%. Of course, the statistical institution said it was 12, but it was 40. So at some point, the president of Argentina goes on TV, in national channels, you cut all the radios, you cut all the TV, and then she says the following thing. She says, look, I know you're concerned about inflation. Has anyone seen me increase the price in the supermarket? Has anybody seen me? No, I've never increased the price. Who increases the price in the supermarket? The supermarkets, okay? Not me, okay? So don't blame me, blame the supermarkets, okay? Now, I'm in my office in Buenos Aires. You laugh about this. I'm in my office in Buenos Aires, and I see Joe Biden. And he said inflation is the meat producers. I said, oh my God, the Peronists have taken over the White House, okay? And I start really getting worried, okay? Anyway, so I'm going to tell you, as this participant of Alcoholics Anonymous, some pitfalls that you may have or you may find on your way trying to get inflation back to 2%, okay? And the first one has to do with your own success. I mean, you have been very successful over the last 40 years. You've had inflation down, so you have this regime of inflation targeting. You use the interest rate as the policy instrument, and you think this is a robust system, okay? So you can keep it there, and then you move the interest, etc. But Guillermo Calvo in 1978 said this is not a robust, because if you have the interest rate fixed, actually the result is indeterminate, you know? So, for example, if my mother would ask me how could I explain the Calvo 78 paper to her, I would say, look, imagine, Mom, imagine that prices go up for whatever reason. Don't ask me why, okay? They went up. And, well, that's going to increase the demand for money. And when it increases the demand for money, it's going to push up interest rates. And because the central bank wants to keep the interest rate fixed, it has to print money so that the interest rate goes back. So prices increase and monetary policy becomes passive. It basically tends to validate that expectations, and that's the way you get this instability, okay? So really, when you have this regime, inaction is really kind of not an option, because if you enact, if you don't do anything, you say the interest rate, you're going to keep it, or you're going to wait to see what's happening, you're kind of going to Calvo 78. I don't know if my mother understood, but probably this group understood this analogy, okay? Of course, we know how to, this is actually textbook material today. We know how this gets solved. You get it solved with the Taylor principle, okay? So if you have a reaction function where the interest rate moves, and you convince everybody that you're going to move it, and you're going to move it sufficiently strong, then the system gets anchored. How does it get anchored? Well, by becoming totally unstable. So the system becomes totally unstable, so there's only one equilibrium, you anchor there. So this it takes us back to Mike's comment on Wednesday, which is that, well, I mean, things has to be more or less stable so that people anchor on that equilibrium because expectations are built in different ways. So I think that the fragility of the inflation targeting regime is something that I think has been a little bit disregarded, and it's all in the textbooks and it's all there. And when you look in hindsight to see what happened in the last 2 years, actually it was all in Calvo 78, okay? The other thing which is on shocks, shocks is another kind of very common way of actually kind of deflecting blame on something else. Let me just show you here. For example, on the right-hand side here, you have the US inflation rate and you have the price of WTI, some energy price. And it's inflation multiplied by 5 and the price of oil multiplied by less than 2, okay? But if you look at the graph on the left-hand side, which is the 2004-2008 period, you see that there the price of energy did not multiply by 1.8, multiplied by 3.2. And inflation moved much less. So how come, if it's so natural that the increase in the price of oil is going to generate inflation, which we kind of discussed at least in policy circles today, why is it that between 2004 and 2008 you have a much larger increase in the price of energy and you have a much lower? And the reason for that is that this is not creating inflation. I like to start in the most kind of canonical and simple. Imagine a world where money is fixed and prices are totally flexible. Well, if the price of energy goes up, well, some other price will have to come down. If you put price rigidity, at the moment the price of energy goes up, well, maybe the average price level goes up because the other prices can't come down, but over time, those other prices will grow much slower than they would have grown if the price of energy would have not increased. So eventually the inflation is not going to be related to this shock, even if you put price rigidity, okay? So what's going on? Because we do actually see a correlation between inflation and the shocks, and the reason for this, what Silvana just explained, which is that central bankers, when you have a negative shock, you try to accommodate it a little bit to avoid the very negative scenario. But it's not that the shock is creating inflation. What's creating inflation is the fact that the central bank accommodates the shocks, okay? And how much they accommodate is going to determine how much inflation. And here we have two scenarios, one where the central bank was more accommodative and one which was not. And I think it's important to have this clear because if you're going to say that the problem of inflation is and I think we're way beyond this point in the US, and in Europe, but if you're going to say, as was said in 2020, the inflation is the price of oil, you're basically saying you're not going to move the interest rate. And if you say you're not going to move the interest, you're back to Calvo 1978 and you're at indeterminate equilibrium. And then you can have even more crazy things, like for example in Argentina, this is a discussion which relates to, say, the pass-through coefficient. Like if you move the exchange rate, you have more inflation. Of course it's a correlation. There's a reduced form which relates those two things. But that's a reduced form which comes from how monetary policy reacts. So if José Darío is the president of Colombia, that reduced form coefficient is going to be much lower than if you have the current Central Bank of Argentina. So this idea that these shocks create inflation, I think, are very, very dangerous. In the case of Argentina, for example, where people kind of tend to assume that if you increase the exchange rate, you're going to have inflation, is what justifies the government having a fixed official exchange rate, now with a black market premium of 100%, which is destroying the economy. And the only reason they're keeping that crazy framework is because they think that there's a relationship between those two things. And basically, that's a correlation, that's not a causation. So I think it's important to distinguish that. Okay, two final points. One is how the disinflation path can be a little bit deceiving. And this has to do with all the discussion on SS rules that occupied part of the time of this conference. So what you have here on the left is Argentina inflation 2016, 2017. So at the initial, we opened up the exchange rate controls. That implied a substantial fall in the demand for money, which was people were forced to hold pesos before we opened up the exchange. So that generated a big jump in the price level. So you had coming for a few months, you had quite substantial inflation, which is what you see there on the left-hand side. And we had a 2% target, 2% monthly target for the rest of the year, okay? But you can see there on the graph that inflation kind of comes down very quickly. You see, I don't know if you can see it here. I don't know if this is the lasers working or not. But you see those bars that come down very quickly. In fact, in August, we had deflation. And why was that? And the reason for that is that when you have a big shock in inflation, a lot of people adjust their prices. This is not the change of the inflation rate as Ivan. This is a change in the level, okay? So you move out from the thing, you go to the corner of SS rule. A lot of people, so then for a few months, nobody's changing their prices. And you think that things have come, well, of course, some are changing, but you have a lot of mass of people who are kind of transiting within the SS band rule. You say, oh, inflation has come down very fast. And then a few months later, you have inflation coming up when these guys hit the lower band of the SS rule. That mass of guys who adjusted at the beginning, they hit the lower bound of the SS rule, and then inflation comes back. So you're going to have a choppy process if you start with an initial shock, which basically bunches people on one point of the SS rule. And if you look at the right-hand side, which is the US inflation, you see this choppiness. And why this is important for policy? Because we may get a month where the month-on-month CPI, core CPI moves perhaps little, and you can't use that to declare victory because the process is going to be choppy, and this may come up along the way, okay? My last point, it has to do with this. Well, of course, you know this graphs. This is the new Keynesian framework we teach our students. So you have a new Keynesian IS curve, a new Keynesian Phillips curve. By the way, the new Keynesian Phillips curve is Calvo. It's Calvo 83. I mean, so all this thing could not exist had it not been for that paper by Guillermo. And so that's the vertical sloped line. That's the new Keynesian Phillips curve. And then the downward sloping is the new Keynesian IS curve, the slope of which depends on how you implement your Taylor rule. So the flatter one would be what John was advocating for yesterday, which is increase more the interest rate, be more aggressive, and the other would be a more dovish Taylor rule, okay? And so you have a whole discussion, which is there this trade-off between how much inflation, how much recession. Of course, if you are tougher with your Taylor rule, you're going to have less inflation, but perhaps a higher recession. Okay, so you discuss all that, okay? Okay, so that's the US when you have a shock to the new Keynesian Phillips curve, which is the red line. You have to go back to the equilibrium, and you discuss this trade-off. So now comes Alcoholic Anonymous, okay? So you talk to the other guy and say, look, okay, this is fine, okay? You can discuss all this trade-off, etc., but this is not the real trade-off. The real trade-off is that you're too dovish. The red line is going to move out there, okay? Because if you lose your credibility, then you're going to have in a much tougher situation. You're going to have to increase interest rates much higher. You're going to have a higher recession. And by the way, Jose Dario mentioned this yesterday, and Jacob Frenkel also made this point. So I would say, just to finalize, is that all these pitfalls, the idea that it's very difficult to understand when you actually have reduced inflation in a permanent way, avoid the temptations to blame any other thing but monetary policy, and the fact that there's a trade-off between your policies affecting your credibility, all point in the direction of kind of being overly cautious and not declaring victory too early on. And I finish with that. Thank you.
Questions from the floor. Yeah.
I'm happy to comment on Federico. He got the wrong shock, by the way. This is a gas shock in Europe. It was not an oil story. And you know, the peak to trough. I mean, things went up by 1,000%, and then came off quite significantly. So you have to, you know, factor that in. It's not. I mean, I don't know if you were talking to me or it's not about blaming. You need to identify the shock. What is the shock that we are facing? What's its persistence? And then how much do I have to calibrate policy to respond to that shock? And here's some simple arithmetic. So when we reached peak inflation last year, which was in November, the contribution of energy and other imported goods to inflation was 8 percentage points out of the 11. The other 3 percentage points was services. Now, that 8 percentage points, I mean, you can say these are mostly prices that are determined globally, and it's these other 3 percentage points where monetary policy has a bite. Now, you can do the arithmetic. In order to reach the inflation target in 2022, we would have needed a services inflation of actually minus 15% deflation, given that the weight of services is 2/5 of the CPI basket now. I mean, that's a massive recession to achieve the target in 1 year. And it would not be consistent with our flexible inflation targeting regime. Now, you can put that into reverse, because what we know is that that 8 percentage point contribution is going to zero, because those prices either stabilized or are actually falling some. So it's either zero or negative, and that's what, you know, changes completely the picture from 1 year to the following 2. So it's not, you know, nobody is blaming. It's identifying the shock and then calibrating the optimal policy response. And then I think we have to be mindful that we're, you know, of our remits. The remit is not to prevent the shock from happening. First of all, the shock is a shock. It's not something that you anticipate in your model. It just happens, and you have to react to it. We cannot prevent the war. Someone else decided that. The role of the Monetary Policy Committee or a central bank is to return inflation to target after the shock happens. And in the case of the Bank of England, the remit is very explicit that in exceptional circumstances, when you face shocks that are large or persistent, you need to trade off the speed with which you return inflation to target against the volatility in employment and output that you generate. So I think that's where the guiding framework comes for how to respond.
I go? No, actually, I was not blaming you, Silvana, at all. It's a general comment, no? And it's very much has to do a lot with the experience I've had as governor and the discussion that I see in general in public. In the case of Argentina, for example, in 2016, 2017, tariffs increased 1,000%. They were multiplied by 10 times, and inflation came down. And in the 2018, tariffs increased much less and inflation increased. Or today, the exchange rate is totally all kind of fixed, and we have the inflation rate at 100%. So we need to understand that the average price level depends on monetary policy and not on these relative prices, because that, I think, confuses. Now, having said that, you have a negative shock, and I think you explained very well how you kind of accommodate or not, to what extent you want to accommodate or not that shock, and that definitely depends on the size of the shock. So we're going to see a correlation between these negative shocks and inflation. I'm just trying to say the correlation comes from how monetary policy operates and not from the fact that one specific price increased.
Yeah, I think we all agree that, you know, in the medium term, in the end, the average price or CPI inflation is determined by monetary policy. That's but in the short run, you can have these spikes, and you can, you know, say this.
And I think we agree also that the central bank maybe makes sense to smooth those shocks and to accommodate those shocks, allow inflation to increase to accommodate the shock. I think I have no problem with that either.
Very good, so we're on board.
All right. Why don't we collect a bunch of questions from the floor, and then we answer in the sequence we spoke. Okay. So. Oh, I have to point. Okay, Carmen. I saw that Carmen had her hand up.
So I am going to direct my comment / elicit a response from James. And it'll actually pick up on something also Federico said, you know. Yes, policy enjoys greater credibility today than when Volcker took over, but Volcker took over at the trough. And the slide down during Miller was a function of inflation lasting longer, more persistent than it had been envisioned and plateauing successively higher, or when it came down, it never fully reverted. So, you know, the narrative of the Fed started out with this is all temporary, which is, you know, I mean, a common policy mistake is to treat bad shocks as temporary and good shocks as permanent. And so the greater the persistence of the inflation, the greater the odds that there's a credibility loss. And so, you know, I want to hear your thoughts on that. But one more question for you. You, a couple of times during your remarks, you said, well, fiscal monetary mix can go back to pre-COVID. Is that enough? Pre-COVID was pretty exceptional already. The Fed balance sheet, which ballooned after 2008, 2009, and ratcheted up and stayed. It never came close. And then, of course, it ratcheted up against during COVID, and this is definitely wartime. And on fiscal, I have serious doubts about reversion. At the end of World War II, we had a spike in government debt, not a plateau in very high levels of government debt, and importantly, fiscal policy was able to reverse gears because a lot of the spending was discretionary, it was war-related, it was not a system in which fiscal expenditures were largely transfers. So that kind of swift reversal at the end of that war, I kind of don't see forthcoming at the end of this war. So,
Enrique?
love your remarks.
Well, Enrique and, okay.
Following the last point that Carmen made, maybe I was wondering about the fiscal picture that you mentioned, and if it is going to be crucial for how much credibility there is on this episode, coming on the fact that Carmen was mentioning, because you were very accurate on using facts to think about inflation expectations, and the monetary side of this inflation. But on the fiscal, if I had to look at numbers, the latest CBO projections put the deficit hovering around 5.5, growing to 7. The public debt is going to skyrocket way past the World War II peak. So I was kind of a bit surprised that you were so optimistic on the fiscal side. Maybe you can elaborate more on what were the numbers you were looking at.
So let me, so John Taylor and then Chris Sims and Joe. Okay.
So I have a very quick question to all three of you. It seems to me that it's a distinction between saying you're sticking to this beforehand and doing it afterwards. And you sort of all have said, okay, we made an error, blah, blah, blah. But the question is what you do now. But I think what really interested is what difference would it have made if you had stuck in the beginning?
That's what I
You know,
showed.
all sorts of people were complaining, you know, not just me. So that's the question.
That's what I showed, John. What would have happened if we started in 2021?
Yeah, with a full model where you're just like you say, the
Wait, let's
expectations
collect a
are
bunch of
taken into
questions.
account.
Okay, because I have here many, many hands. Okay, Chris, sorry, John, are you done with your question? Okay, so just so that you know, it's Chris Sims, and then you, Seb Nem, and Andy, and then you're gonna get the last one. Okay.
Okay, I'll be very quick because it's kind of piling on to Jim. But one way to think about the fiscal policy is you want us to believe that there's a change in regime, and you justify that by pointing to simple inertia, that there's a divided parliament, a divided Congress, and there's unlikely to be increased expenditure. But the amount of public debt is much higher now than it was pre-pandemic, and that means that there has to be a smaller primary deficit to get us back to a sustainable fiscal framework. And that requires some sacrifice. And I think the examples of costless disinflation you refer to are examples where people accepted additional sacrifice on the fiscal side because things were so bad and they knew they had to change. And you're trying to, the fiscal freeze that you're talking about on spending isn't quite enough, I would think, to accomplish that.
Thank you. So my question will be for Silvana, but I just first wanted to say, Federico, I love the way you're presenting this stuff, so congratulations. Silvana, in your model, inflation kind of goes back very much to the target. And we've been talking for 2 days about the role of the assumptions in terminal conditions in all the models that simulate what's going to happen. So can you talk more about those assumptions in your model? Because I wonder to what extent they matter.
Yeah.
Seb Nem?
I have a question for Federico. There are lots of talks about having a nominal interest rate that is higher so that you can go down and to take advantage inflation is high now to change the inflation target. And I would like to think what you think about changing the inflation target.
Seb Nem?
Yes, I want to ask, especially to Jim and Silvana, in terms of the pace of the hikes. So just going back to what Federico said, okay, let's not blame the shocks and all that, but let's also not forget the COVID shock is a very, very unique shock. And you can actually quantify those things, and you don't need the gas shock or the energy shock, Silvana. So we did this for the ECB Sintra, but last year, we stopped at the end of 2021 on purpose, not to get to Russia-Ukraine war. And when you do US, Europe, and UK, in US, 2/3 comes from the demand, 1/3 from the supply. Here, the supply shock is labor supply shock, all sorts of, input shocks, because we had a COVID shock that restructured the economy completely from services to goods and then back to services. So that's, pretty much 2/3, in the US, 1/3 in the Europe and UK. Yes, the rest, the supply is more in Europe and UK. But then, when you go to the what drives that demand component, it's a lot fiscal stimulus in the US and, some other stimulus in Europe and UK. So everybody did some stimulus. So in that sense, you are facing a real shock, your economy is going through recession, there's this huge supply-demand imbalances coming out of that at the sector level. And going back to Federico's point, yes, of course, this is relative price. So if something goes up, the other goes down. But you don't need price thickness for that. You can do a network model with downward wage rigidity, and that slow adjustment or never adjustment downward still give you some serious inflation in the short term. That short run can be long. Now, knowing all this in the hindsight, and everybody agrees that you have to decrease this, why small hikes? Another approach can be larger hikes, right? I know your reasoning, but maybe you can a little bit, go through that.
Okay, I'm going to give the last question to Liliana. I know there are other people who want to talk, but we want to hear the answers, and we have to, unfortunately, then I invite you to continue after lunch. But this is going to be our last question, and then you, the panelists, can answer.
Yeah, just briefly to Jim. I would like to know if there are estimates on the cost of the Fed's delayed response. So, you show how expectations of inflation increased during 2022 when the Fed was not raising interest rates. And so, of course, if there's any transmission of expectations of inflation into inflation, you're going to have to raise interest rates more than you would have had to if the response would have been appropriate at the right time. And this is important because of the effects of interest rate have, as this conference have shown, to the rest of the world too. And so the cost of delayed response of the Fed could be very high for the world.
Do you want me to start so we get the last word to Jim?
Okay.
Most of the questions have been for Jim, so I'm going to be very brief on the change of targets. Go back to Mike Woodford's lecture. He said, the system is unique because it's unstable. So you have to be careful with rocking the boat because you may get on a path which is dangerous. And in fact, the Fed changed its target in 2020. So it went from, 2% to average 2%. Coming from Argentina, I always thought that was a little bit like, I understand these models that you have to say that you're going to have inflation because you're hyper deflation paths and all that, okay? But coming from a country with 100% inflation, I always thought that it was a little bit like playing with fire, those kind of things. And I don't know if that is what explains to some extent what happened afterwards, but certainly it's there, it's a component. And it's a very interesting question because today the Brazilian central bank is under pressure of the executive to change its inflation target. So it's a very important topic, and I think, as Jacob said, if you're going to change a target, you do it after you've achieved it, never before you've achieved it, because that's a tremendous source of instability.
So I want to start, that one. With John's excellent question, because I think we need to engage with a quantitative question. What happened if you started a few months earlier? Here, this is a simulation asking what happened if you started in mid-2021 when you started to see some signs. And so this is the type of questions we should be asking. And this is, the point I was trying to make here is that if you, went for it, hit the target in 2022 in the UK, that would have necessarily meant a big undershoot afterwards, because it's very hard to hit a target when you have the external factor playing such an enormous shock, and this unwinds so quickly, either because prices stay high or there's some coming off, and that relates to your question on how robust is this falling inflation, and this purple one shows that it's coming below the target, and again it's coming from that arithmetics. Obviously, if we see another energy shock, this is not going to happen, but it's just going from that 8 percentage point contribution and to 0 in 2 to 3 years, so you get a very speedy fall. And then what you're left with is the services part, and then you have to ask, okay, how much is that going to come off given the policy tightening in place, given the fact that a big component of services also relies on energy, and that's transport, accommodation, restaurants, and so on. And then we're obviously looking and monitoring the high frequency data, expectations, et cetera, and what we have seen is again in the high frequency data, the services inflation is falling, the wage inflation is also falling. And so that's the type of. Pardon me? We have a long-term condition, and this is in the long term, inflation returns to target because of the actions of monetary policy. But this is the part that we have to, it's a fixed point at the end, and that's the part that, we are monitoring, and that's where, if we see a deviation from what we have in our forecast, and we have many ready reckoners to check, that's when you, recalibrate your policy in response. And to Shebnem, the demand picture, as I show you, Shebnem, is very, very different. I missed it, my tool. And it's, well, it's on moving now. The story is pretty different in the US and the Euro area and the UK. You ask, okay, what are the arguments for going in small amounts? This has been a super sharp tightening. Let's not get it wrong. It's in a year seeing 400 basis point increase is a lot. Why not doing more. Well, I told you, if you did more, then you would have understood in the medium term, which is against our targets. But there are two arguments for going slowly. One is Phil Lane's about, not creating a financial crisis by going too fast, and the other is about learning about the persistence of the shock. And again, you recalibrate your policy as you go. You don't want to overdo it because, why would you cause an unnecessary recession? So those two arguments. And then Jim.
Okay, thanks very much. Lots of interesting questions. One from Carmen Reinhardt. The initial temporary story, did that hurt the credibility of the Fed? I think it did. I think we would have been better off to acknowledge more. I do think there were some actions taken in 2021. The way this will be written and the way you guys will write papers in the future, it'll look like the Fed moved in March of 2022. But actually, there was a lot of action before that, and we could talk about that more. But I do think it hurt our credibility to tell the temporary story initially. And then are we really going back to the pre-COVID, and was the pre-COVID all that great? Because you actually had a very large balance sheet. But the only thing I want to take out of the pre-COVID era is inflation was 2% or less for about a decade. So whatever you think was wrong about that era or whatever you think was going on, I just want to return to that, and then we can fix other problems maybe at that point. But it certainly had 2% inflation. So from the point of view of expectations, if you say, I'm going to go back to the pre-COVID world, which may have its own problems, but inflation wasn't one of them. And on Enrique Mendoza says, well, is fiscal really fixed? You got a bond, government debt to GDP ratio of 130%. One thing I've said here is, well, if there was ever a time of social emergency or war where you'd want to borrow a lot and spend a lot to prevent damage to the economy, this is probably it. So this was probably a good reason to borrow. And you are going to have to, I guess a Barrow-type model would say you're going to have to pay that off over a very long time period. But the borrowing by itself, unless it's viewed as uncontrolled, even after the war is over, it should be sustainable. If you want to say that that's going to cause a lot of inflation going forward, then you have to explain Japan. John Taylor, why didn't we move sooner? So I would just say, 1 or 2 years ago, it's sitting here, 2 years ago, there wouldn't have been any inflation to speak of in the U.S. and no expected inflation either. So it's really as of March 2021 that the inflation really came. And I think it's pretty clear that you had a fiscal impulse that was excessive around that time period, the first quarter of 2021. So you had this big response to the COVID itself. And just to remind you, that's March, April of 2020. I think, a brilliant response, basically to the pandemic, despite dysfunctional politics in the U.S. But then you got to the end of December 2020, and both parties decided to again put $1 trillion bill on the table because both parties were competing for the Georgia election and the control of the U.S. Senate. And then the Democrats came to power and they wanted to go again with a big package. At that point, it's not that unusual for a party that comes to power to want to have a big spending bill. So, but those were both, I would say, more politically motivated than motivated by the pandemic itself or the response to the pandemic itself. So another point I'd like to make about starting sooner is that what I felt at the time was that, if you recall, the details matter, but the vaccines were just going to come in earnest March, April, May, June of 2021. That's when most people got their vaccine. And I felt like you don't really know if that's going to work or not. You could have easily killed 100,000 people with that. You just don't know. And so it did go very smoothly. It was brilliant science and everything. And by the time you got to July 1st, 2021, deaths per day per million in the U.S. were down below 1. And I felt like at that point, if it had ended cleanly, especially at that point, we could have gone ahead. Now, then there were after effects and mutations and so on after that, so it didn't end as cleanly as I would have liked. But I do think from a policy perspective, I switched my attitude right around July 1st, 2021, and saying, okay, this is the war. So it's like when you have a war, it's like, what is the news from the front? Okay, how's the war going? And if you felt like, okay, I feel like the war's going pretty well now, we can return to monetary policy. And so that's what I was thinking. And we did make moves in the second half of 2021, but other things had to be done before we could get to interest rates. Public debt, does it really, Chris Sims, public debt, does it have to decline going forward? In the ends of 4 big inflations examples, the League of Nations came in with all 4 countries, signed a protocol and said they were going to monitor expenditures. This is a way for those governments to get credibility that they weren't going to continue to spend at outlandish rates, and they were going to control their money printing. So it seemed, or what I take from that is that the freeze on spending was enough to get expectations lined up and get that under control. They were going to run primary surpluses going forward, and that doesn't look like it's in the U.S. future, but the freeze is going to help a lot. Estimates of the cost of the Fed's delay. So I don't have an estimate of the cost, but I have made the argument many times that, move quickly now, reestablish credibility now. Sometimes I use the phrase, more game theory, less econometrics. What you really want is the establishment of the credibility of the 2% inflation target. There's a certain amount of demonstration to markets. If you move quickly, we move 75 basis points 4 meetings in a row, and that, if you look at my last chart, that did seem to have dramatic effects on the credibility of the inflation target. If you don't do that, you risk getting into a 70s situation where you have to raise even more later and possibly disrupt the real economy even more later on. And then Federico, average inflation targeting. The Fed did go toward average inflation targeting in our last revamp. I viewed it as a step toward price level targeting. This is a policy that's done by committee, so you don't actually go to price level targeting, but a step in that direction. The spirit of it was very much to try to handle effective lower bound issues associated with inflation targeting. So the way I'm talking about it now is that when inflation is very low and interest rates are close to the zero bound, then you might look at this flexible average inflation targeting framework and to see how the Fed's going to behave. If inflation's very high, see Volcker 1981. So, it was often said when we were going through this that, oh, well, inflation's high. We know what to do then. So the question wasn't what to do when inflation's high. The question was what to do about the zero bound, how to get out of this situation where you're missing the inflation target to the low side for a decade, as has happened, or more, as has happened in Japan and Europe and the U.S. So I think flexible average inflation targeting has been misinterpreted a little bit, but it's mostly designed for that low inflation, low nominal interest rate situation. So I'll stop there. Thanks for all your questions.
All right. Thank you very much. I think you have an announcement right where we have to go. But thank you to the panelists.